Hello, everyone. We'll give it a minute for our attendees to trickle in. Love seeing some familiar names in the chat. Very nice. Yay. All right, great. So welcome back, everyone, if you've been to other chats before, and welcome if this is your first talk of the day. And I'm here with the amazing Aaron Smyle, who's the owner of Smyle & Associates, LLC, which is a tax and accounting firm for businesses and individuals. And he's going to be talking about something extraordinarily important today, which is how to take the fear out of taxes. And I have a lot of fear with taxes, so I'm very excited for this one. So without further ado, Aaron.
Thank you very much, Zoe. I would like to start by saying taxes are not scary. They shouldn't be scary. Sometimes it's thought about and synonymous with going to the dentist, but I can assure you what we're going to talk about today really should not scare anybody. Hopefully there'll be a little bit of education. You guys will learn something. Any questions, please feel free to ask. We're going to go through a couple of topics that should be pretty imperative and important for a lot of us today. So again, my name is Aaron Smyle. I'm owner of Smyle & Associates. We are a tax compliance and financial planning firm with offices in New York City, as well as in upstate New York in Rhinebeck, which we're actually currently sitting in now. I'm going to share my screen, and we're going to start with again, the presentation. Again, anything that you guys want to know more about, please feel free to let me know. We're going to go through what creative firms should be doing now. We're going to talk about the Paycheck Protection Program, specifically the forgiveness applications are coming due now. So I know that's something that a lot of people are certainly worried about. A lot of our clients are going through their application now, so we want to make sure you guys understand at least the initial aspects of that. We'll review the Paycheck Protection Program a little bit. We're going to talk about a payroll tax deferral, which is in the news. We're going to talk about the designation and the differences between an employee and an independent contractor. We're going to talk about some working from home considerations and residency issues, all of which again, I think are pretty pertinent and front of mind with a lot of what everybody is going through at the moment. So what should creative firms be doing right now? If you're an interior designer, I'm sure you've heard it or had to convince a client that they can't do it by themselves. You know, with Wayfair, with other areas, people think that they can just go on, they can hang a painting and all of a sudden they're an interior designer. And we know that that's not the case. I would say the same thing is true from an accounting standpoint as well as a legal standpoint. With LegalZoom, with TurboTax, people feel that they can do it on their own. Although I'm slightly biased, I would advise against that. So creative firms, we should be looking at hiring the right professional who can help you with your business. Who is going to give you the best relationship? Because the prospect of this is a long-term relationship. This isn't a transactional approach. So you want to work with somebody that's going to give you an educational component to this, that's going to break things down, that's going to make things less scary, if you will, because with education comes empowerment. I can't tell you how many times we've had a meeting with a client where when we're done, they usually say, well, that wasn't so bad. So that's something that you guys need to look at. Find somebody also that, if possible, doesn't bill by the hour. You don't want somebody that is nickeling and diming for your time. You want somebody that's going to give you the attention that you need. And the way to do that usually is with the flat fee model, and that is what we utilize. You want to set your expectations. Where are you compared to last year? A lot of us are dealing with really an unknown world, a new world that COVID has kind of brought to us. So looking at last year, where were you spending money? How were you spending money? How does that compare to this year? Should you adjust your billing? Should you adjust how you are managing your business? Should you adjust how you work with clients? All of this in somewhat is the come to Jesus moment, where maybe what we were doing last year wasn't working. So now you're kind of forced to sit down, to take a look see what you're doing, take a holistic approach and make some changes. Take an honest assessment of your industry. You know, there may be a hole in the industry and what you were providing. See if you can change and be a disruptor in your industry and offer things a different way. Offer not necessarily creating or recreating the wheel, but making things more efficient, providing a service that wasn't initially there. Know what your expenses are, both on a fixed and a variable standpoint. A lot of clients specifically are dealing with a rent issue. They've been at home, they're sitting paying rent, that's a fixed cost. What can you do given the environment to manage those expenses? How can you map out what those expenses are going to be? The fixed ones you may not have any control over, but at least you know what they're going to be in the coming months. The variable, you're going to have a little bit of, there may be a little bit of an issue in how you can manage those. If you think of certain prices, certain products may increase, they may be out of your control, but what you want to do is be able to manage that, look at your budget, and make sure that there are no surprises and that you are able to stay in business. We're coming towards the end of September, so everybody should be reconciling their books. What you don't want to do is wait to the last minute. You don't want to be reconciling all of 2020 in 2021. You may not remember what some of these expenses were. So take this opportunity at the close of the third quarter to make sure that you're all caught up. Certain expenses are identified. If you're using QuickBooks, there aren't that many Ask My Accountant categories. This way you can effectively plan towards what we're coming up on year end. And if there are any taxes that are going to be due, again, you can make sure to set that expectation level. Make sure that estimated tax payments are paid or have been paid, or again, at a minimum, with your books up to date, you know what you're going to owe. What you don't want, again, given this environment, are any surprises. You don't want to have to file your tax return next year in April and realize that you're going to owe $20,000, $30,000, whatever the number may be. It's much easier, even if you don't necessarily have the funds today, to set that expectation level so you're not surprised. It's one thing to owe the money, it's another thing to know that you're going to owe the money. The other thing, if you're dealing with products, make sure that you're registered for sales tax. We are going to talk about payroll taxes, but both payroll taxes and sales taxes owners are personally liable for. So you want to make sure that you're registered in the state that you live in. If you have either economic nexus or physical presence and nexus in other states, you want to make sure that you're registered in those states as well. Again, what we really want to do is mitigate any surprises and make sure that all I's are dotted and all T's are crossed. The Paycheck Protection Program, this is something that a lot of people really did take advantage of. A lot of our clients took advantage of. There was some changes that were made. It was called the Flexibility Act. And what that did is it lowered essentially the amount that you needed to spend on payroll down from 75% to 60%. So the initial act said, in order to get all of your funds forgiven, you had to spend at least 75% of them on payroll. Now, with the Flexibility Act, that has been brought down to 60%. So that leaves you another 40% to spend on rent, on utilities. If you have a home office, which we will also discuss, that would count also. The loans have a very low interest rate. So if you were able to secure one and you are unable to have all of it forgiven, the interest rate is only 1%. So that is a very low rate. It is very cheap money to borrow. What you want to do is be able to maximize what your forgiveness was. The other addendum, if you will, of the Flexibility Act was allowing you to choose 24 weeks of a forgiveness period as opposed to the initial 8 weeks of a forgiveness period. What this allowed is businesses that were suffering and businesses that were having a hard time getting back up to speed, either given a closure, if you're a restaurant, if you're a bar, even if you're a store, with a lockdown in place and or people's behavior changing, You may not have either had full staff, you may not have had full sales, certainly. So the extra lead time of now 24 weeks may allow more people to take advantage of the program and will allow more people that additional time of forgiveness. The caveat is if you elect and the borrower can choose the election period between the 8 or the 24 weeks. It is up to the borrower, not the bank. So now that now that individuals are starting to put their applications for forgiveness together, there are several payroll companies, ADP I know does it, Gusto does it. They put certain reports together where you're comparing your headcount and your wages from the period pre-COVID to the end of the forgiveness. So if you do elect the 24-week period, you just have to make sure that at the end of 24 weeks, you still have the same amount of people. They could be different people, but you need to have the same number of headcount and the same number of payroll in order to maximize your forgiveness. Accounting for the loan is another issue that a lot of people are dealing with. Initially, the money that you receive from the Paycheck Protection Program is not considered income to you. So if it's not considered income, you're not allowed to take a deduction for the expenses that you're using to pay with these funds. So if you are paying rent, if you are paying your employees, if you are paying utilities with these funds, they are not deductible. So the proper, and not to get too much in the weeds, essentially the Paycheck Protection Program needs to go on the balance sheet and not the profit and loss. As it goes on the balance sheet as a short-term liability, as these costs are being incurred, you're able to reduce the liability, which is what you want to do. The problem that is starting to arise is that the forgiveness, the true forgiveness, may not occur until next year. There is a lag time between your bank approving it, that going to the SBA, and then the SBA approving it. So if the SBA does not say the entire amount is forgiven until 2021, you've already closed your books for 2020. What we're advising is if you expect the amount to be forgiven, if you follow the rules, if you've maintained headcount, if you've maintained wages, then treat it as a liability and do not take the deduction for these expenses. Essentially, that's creating a double dip and a double benefit, which you don't want to, you're not allowed to do, essentially. If any portion is not forgiven and turns into a loan at the end of the day, those expenses can be used essentially off the profit and loss, and you will be able to get a deduction for them. So again, instead of filing an amended return, or the other option is to file an extension and wait until you get true acceptance from the SBA about the forgiveness, what we're advising again is treat it as a liability. The expenses, the money that you're paying will reduce the liability, and then you should be flat at the end of the day. That's kind of the goal. So you want to be able to maximize the forgiveness. You are not allowed to take an expense for the money that you received because it is not considered income to you. I just want to see, we do have some questions that we can, we will review these I will come back to these, I promise. Some other things that we want to talk about before I get to the work from home are the payroll tax deferral. So there are two components. There was a payroll tax deferral that was part of the COVID legislation, and this was on the employer side. So the employer had the option to defer payroll taxes for a year. They needed to be paid back though, but as I mentioned earlier, owners are personally liable for the payroll taxes. So if you defer the taxes, and let's say unfortunately the business has to close, the owner is going to be on the hook for these, and you will need to pay these back. They are not dischargeable in bankruptcy. So I would not, and we did not recommend deferring the payroll tax in the event that it could come back and bite you at the end of the day. The second area was not a law. This was actually a memorandum that was signed by the president. And this is a payroll tax deferral at the election of the employee. Now, what this essentially worked out to, I believe the technical term is actually a gimmick, is it is a short-term loan. So the employee would be able to defer their payroll taxes for September through December, but then it would need to be paid back starting in January. So to give up a little bit of money today that comes into your pocket, that would have to be paid back in January. It's only a short-term loan. We're not recommending that that's done. The other side, from a compliance standpoint, is let's say the employee decides to defer the payroll taxes. I, as the employer, am the one who remits and collects them. If the employee leaves in January or February and we're unable to claw that money back, what is the recourse? So then funds will have to come from another area, and this is just going to further exacerbate the problem of the Social Security Trust Fund, where there may not be enough money in the future, which is what most people's concerns are. Will there be Social Security in the future? Well, this is one way to actually deplete the funds, because Social Security is constantly paying out, and if not enough people are paying into it, there is going to be a shortfall. So just be careful. Again, this was not a law. This was not passed by Congress. This is simply a memorandum signed by the president. We have not seen it go into practice much. And again, I don't think it's something that should really be looked at or even taken seriously, to be honest. Going to work from home. A lot of people are now working from home and not by choice. And there is a home office deduction that's available for everybody that is working from home. The rule in order to take the home office deduction is that the area has to be used exclusively and only as your office. Locally in New York City, people live in a 300 square foot studio. You may have your bathroom over there, but your bedroom is your living room, is your closet, is your office. It's a little bit harder to claim the deduction there. The true spirit of the deduction would be if you had a 2-bedroom or 4-bedroom or 5-bedroom home, one of the bedrooms serves as your office. And the way the deduction works, just to keep math simple, if one of the rooms was if the entire home was 1,000 square feet and one of the rooms was 100 square feet, you would be able to deduct 10% of your rent or your mortgage, your real estate taxes, your utilities. So it is not a random percentage that one can choose. It is directly allocated to the size of the office. Now, if you were building out your basement, if you were replacing the windows, if you were painting, that to your specific office, that would be 100% deductible. And that would be fine to take. That would not have to be spread out pro rata over the entire space. One thing that I did want to talk about earlier as well was the employee versus the independent contractor. If you are growing, a lot of interior designers actually are very busy. Some of the travel budget that was set aside for a family trip to Italy is now being spent redoing the kitchen. Or in that example where the home office is now being created, it didn't exist. Now we need to have somebody come in, but the interior designer needs help. In determining whether somebody is an employee or an independent contractor, there's about a 25-factor test. The biggest determinant is control. If you control what they do, when they do, how they do, and their rate of pay, they're an employee. And you cannot get away with designating them as an independent contractor. If the person that you hire has their own business, if they perform similar services for other companies, if they set their rate of pay, then they can be an independent contractor because they are completely separate and they are not controlled by the employer, excuse me. If you are looking to hire an employee, the employer should consider about a 10% increase in costs. So if you were going to pay somebody $50,000 for the year, your true costs would be $55,000, and that would include payroll taxes, unemployment insurances, both at the state and federal level, and possibly payroll filing if you utilize a payroll company. So just from a budget standpoint, that's something to be mindful and cognizant of. Finally, a very hot topic again now is going to be residency issues. A lot of people have been displaced. If you were working, if you were at home, you were working in an area, you are now allowed to work remote, you decided to go to your cabin, you decided to rent a home on the beach, you're working at your parents' house. if it is not your primary residence, a lot of people are questioning, what state am I actually going to pay tax in? Residency, especially now, is going to be a very hotly debated topic. With states broke, people are going to be looking into this. So residency, similar to the employee independent contractor relationship, is a several factor test. The biggest is going to be intent and permanence. COVID has created a temporary, hopefully temporary situation, not a permanent one. So if you left your home to work outside or a different state temporarily, you are still going to be responsible for income tax in the state that you live in. If you are working at changing your residency, there are certain items that can be done. Driver's license would need to be changed, voter registration would need to be changed. They look at ties, where your kids go to school. If they're still in school in the old jurisdiction, your ties may be closer to that old jurisdiction, not the new jurisdiction. They're going to look at where your dog is, where your pictures are. So just because you're away from your home, typically residency is determined by a 183-day count. You may hear that I'm going to be in Florida for 6 months plus 1 day. That's at 183 days in order to avoid state tax. It's not that simple. So again, keep in mind that you can only have one home, one true tax home, and the permanence and the intent of where you are actually living is what is going to determine what your residency is. Now, there are, again, ways to update your residency, change your residency, make a claim that you are no longer in the city, in a particular state, and you want to be taxed in the other state, but the onus is on the taxpayer to prove that, and residency audits are going to be hotly contested going forward and very closely looked at. I know we went through a lot. We don't have that much time, but I do want to leave some time for questions. So if there's anything specific, again, that anybody wants to ask, Zoe, if you want to kind of manage those, I'm more than happy to go through them.
Yeah, definitely. So we have a bunch of questions in the Q&A and the chat. I'll start with the ones in the Q&A, and I'll kind of try to group them together if there are similarities.
Sure.
So there are two questions about kind of like what rates are taxable at what. So the first question is, what is taxable at what rates? If you have site locations in different states, it gets difficult to bring it all together. And then the second, which is similar, is my design fee taxable at the sales rate tax or service tax rate? So hopefully those are.
So sure, there are two different concepts. There's income tax and there's sales tax.
Mm-hmm.
So from an income tax standpoint, you will pay income tax to the state that the income is sourced in. So if you live in New York, but you go to Connecticut and you're performing services in Connecticut, in theory, you may have Connecticut source income. So the rates themselves, it's a graduated rate system. So from a tax standpoint, we have both an effective rate and a marginal rate. The effective rate is average tax over time, and the marginal is your last dollar tax. So your income tax is going to depend on how much money you have. You, your spouse, your family, from a tax standpoint, your interest income, your service income, all of that will go to determine how much tax you're going to pay. Certain states, California, for example, if you have a client that is in California and you don't live in California, California is going to tax you on that income, whether or not you are in California. So you're going to have to look at each specific state and determine whether or not you have what's called nexus, either an employee, an office. If you have any of those items in a state, you could be deemed to have nexus in a state and will have to pay in that state. From a sales tax standpoint, services are taxed differently than products. In New York, for example, interior design services are subject to a different tax rate in each county that you are in, not subject to tax in New York City. Products, similar. Different products, depending on where they're shipped to and where the client is, are going to be taxed at a different rate. So certain states have a flat sales tax, and certain states have a per county sales tax. So it will depend on where you're actually working.
Okay, amazing. Thank you so much. Then we have two questions from Till, which are sort of related again. So first, how do I handle situations where I pay taxes to my vendors on my client's behalf? And then what happens if the client pays for items using their credit card?
So again, I believe you're talking about sales tax, I would guess. When you file your quarterly sales tax return or your monthly sales tax return, you would reconcile what you paid and what you collected. So sales tax is not your money. If you are collecting it from the client, let's say you're going and you're purchasing a table, you're going to pay sales tax for the table. You would then have to remit the sales tax to the state. If your client paid you for the sales tax and you billed the client the sales tax, you are essentially the conduit between the client and the state in order to pay that amount. If you have a resale certificate and you're offering the resale certificate when you buy the product and no sales tax is paid on the product at that time because you're reselling it, then it is up to you to charge the sales tax to the client and then again collect it and remit it to the state.
Amazing, thank you. Our next question is, apart from payroll protection, are there any other programs that interior design firms can benefit from as they deal with COVID-19?
The EIDL, the Economic Injury Disaster Loan, was something that people should have taken advantage of. Right now, there are no new programs that are in place. The Paycheck Protection Program is over and closed. The Economic Injury Disaster Loan assistance is closed also. We are anxiously waiting for another round of either additional Paycheck Protection Program, possibly additional loans. There is what's called an employee retention credit. And this is not necessarily for interior designers, but for anybody, if your gross sales have suffered a 50% or more decrease in any quarter this year compared to last year, there is a pretty sizable and generous credit that's available to you. Either the good side or the downside of the Paycheck Protection Program is it was really for everybody. Interior designers could take advantage of it, restaurants could take advantage of it, accounting firms could take advantage of it. However, based on the nature of the business, restaurants are closed, bars are closed in certain areas. They can't use the money because they don't have staff. Interior designers may be busier now and they can use the money. So getting that money could help them either pay existing staff and or additional staff in order to bulk up based on need.
Amazing. So I think that's all the time we have, but thank you so much, Aaron. This was so helpful. I really appreciate you talking to our audience today.
My pleasure. Again, any questions, please feel free to reach out to us. More than happy to help.
Amazing. Do you want to maybe type your email in the chat?
Sure.
And people can reach out to you? Perfect.
I will do that. Absolutely.
Excellent. And while he's doing that, I'll tell everybody we have 2 more sessions remaining today. The next one will start in about a minute, and we're going to be discussing cold calling for interior design. So everybody get excited for that. The link should be in the chat. Excellent. And that is perfect. Okay, cool. Yay. Thank you so much to everyone who joined. Thank you, Aaron. And we'll see you on our next chat.
Thank you, guys.